Hello, everyone, and welcome to the February 2025 edition of the Macro Microscope series. I'm Indrani Day, Head of Global Investment Research at FTSE Russell, a London Stock Exchange Group company, and I'm joined by John Dioufas, Director, Data Stream and Macroeconomics, London Stock Exchange Group. So today's episode, we are going to touch upon potential financial market implications from trade uncertainty. Now, before we jump into the presentation, a quick disclaimer. FTSE Russell is not an investment advisor, and anything said in this presentation is purely for educational purposes. Now, with that, let's jump into our thoughts. We are right now in the midst of big policy shifts in the United States, and the full extent of those actual policies are yet to be seen. So, as we look out into this outlook, how could potentially different equity markets get impacted? Now, this is, of course, an area where the transmission channels can be many, many. So, I'm going to concentrate on three channels of possible transmission and look at potentially through each of those transmission channels who all could be impacted. And my universe is the G20 countries. And I'm going to look at the different country equity indices through the FTSE GEES index series lens, the equity indices for different countries. So, of course, the first potential and direct transmission channel is which of these equity indices at the headline level, at the index level, the index constituents having their maximum revenue exposure to the United States market. So that's the chart on the left, the country indices, their revenue exposure to the United States as a percentage of their total revenue, of course. Now, by this particular measure, the countries that come up very high with revenue exposure to the United States, it's Canada, United Kingdom, Germany, France, and Mexico. And this is something I want to highlight through each of these financial transmission mechanism. It's both emerging markets and developed markets that have a high exposure. Now, the second way of looking at it is it's not just policies emanating from the United States, it's also the counter policies from other countries. So as policy changes and counter policy changes reverberate through the global trading system, essentially countries whose GDP has a high exposure to exports, whose economic model is based on a high export intensity, those countries have a high exposure. So the second chart we look at is exports as a percentage of the GDP, 10-year average for the different countries. So here it comes across that the countries with high export intensity or high export dependency, it's Germany, South Korea, Mexico, Saudi Arabia, and France. So another way to look at it is if you put the two measures together, obviously if the equity indices have a high exposure to US markets and those countries have a high export intensity in their economic growth model, they are more open to, they are more impacted by the changes that could happen. Likewise, countries that are lower on both these measures are comparatively more resilient to the changes reverberating through the system. So the countries that come up high on both these exposures in terms of revenue exposure to the United States and a high export intensive GDP growth model, it's Germany, France, Canada, and United Kingdom. And countries low on both these measures in the emerging markets, we have Indonesia, China, India, Brazil, and Australia. Now, as we said, the transmission mechanisms can be so many and they're so varied. So as we touch upon the third way we are looking at things, that in the sense if there is uncertainty in the US and it impacts US equity markets, and by definition then the global equity markets, because US equity is such a big part of global equities. So if anything that happens in volatility in the US equity markets, which are the equity indices that will get more directly impacted? It's countries whose equity markets have a high beta to the United States. So we look at the 5-year beta versus the FTSE United States, and the countries with those very high beta, it's South Africa, Brazil, Germany, Australia, Mexico. So again, just to highlight, these are just three possible financial transmission mechanism, and on pure economics within the G20 universe, which countries have a high exposure to each of these transmission mechanisms. And with that, I turn it over to John.
Thank you, Indrani. And yeah, Indrani, you make a series of very interesting points that there's a lot of uncertainty and also the beginnings of a lot of macro uncertainty, which could lead to volatility. I'm going to start my slide with just the first round of the key central bank rate decisions. So if we look at the G7 and the key emerging markets, their central banks announced their policy rates for the first round of those policy rates in 2025. We covered 12 central banks. And of the 12, only one held rates, which was the Federal Reserve. And they're on record, well-established fact now that they're going to be driven by the data. They're keeping an eye on inflation, but they're also keeping an eye on economic growth and the employment situation in the United States. So they kept their rates steady. 9 of the central bank cut their rates, right, which included the European Central Bank and the Bank of England on the G7 side of things. And then only 2 central banks, the Central Bank of Japan and the Central Bank of Brazil, hiked their rates. Now, Japan's economy, by some definitions, is 25 to 30 years ahead or in a different cycle to everyone else's. So inflation is back in there now, and they're obviously hiking rates to counter inflation. Brazil, as a large emerging market, always has to deal with inflation. So it could be that we see them hiking, but within a year or so see them cutting again, whereas Japan seems to be pretty much in a tightening phase now for the next couple of years. What that does, though, is it creates a series of imbalances in the markets. For example, the yen carry trade may no longer be a viable option to financial institutions. So that might cause ramifications in other part of the market, right? And some people are saying that, well, if you take the yen out of the equation, potentially it's pound sterling that could be the alternative should sterling become more attractive as a potential carry option. But what was also very interesting, Indrani, if we look at extraordinary economic surprises, in other words, those economic surprises where the number that is released into the market is substantially different from the consensus of the market. So either the actual number reported is above the maximum range of the forecast sample or below the minimum range of the forecast sample. Now, that is what we at LSEG DataStream call an extraordinary economic surprise. And when you get a whole lot of them in a short period of time, we look towards the idea that there's a lot of uncertainty out there about the actual values that are of the numbers that are going to be reported by the various national statistic offices or central banks. And what you have is a situation where the market is overestimating or underestimating the value of the data. And if you look at these 24 extraordinary economic surprises over the last 6 working days, what you really see is the mix across economic categories such as produce and consumer sentiment, labor market, and trade. And on the last slide, what we want to always look at is how is the market preparing for increased volatility and macro uncertainty. And what we want to do is look at the gold price. Now, everybody knows that gold is trading at all-time highs, and that's fine, but it doesn't really give us a context that we need. The context that we want is how is gold trading relative to something else, and in this case, it's silver. So we're looking at the gold-silver ratio, and we see that over the last 40-odd years, 46 years actually, that average for the ratio is at 65.22, and we're currently trading at 89.80 above. And what that tells us is that, the market is preparing for something, and it's looking to put its available funds into a store of value that's considered a safe haven, such as gold. And on that note, I'd like to thank everybody for dialing into the call. Thank you very much.
Thank you. And that brings us to the end of today's episode of Macro Microscope. Thank you all. Bye now.
Thank you.